Morning, everyone. Thanks for taking the time to come and interact with us today. I would really hope that we keep this session as interactive as possible. What I will present, I hope we use it more as a backdrop to a discussion. Now, before I go, I have a few slides that I'll go through, but before I jump into those slides, I would like to hear what people expect. I think the topic or the title is Understanding Loan Markets. Now, that's the overall title, but there's going to be something you are trying to achieve when you woke up on a Saturday morning and decided to come for this discussion. So maybe 4 or 5 people, and I'll need somebody to write for me here, a volunteer. Wayne will do it. So what are the expectations that you have today? And if you don't volunteer, I'll volunteer you. Okay, and you will stand, say your name, and then your expectation.
Yeah, my name is Daniel Buthia.
Daniel, why don't you stand so that they see who is Daniel Buthia? Part of the goal of this session is also to interact and get to know each other.
Yeah, my name is Daniel Buthia, and I'm born again. I had about 8 expectations, but I think I will deal with one.
Just one?
Yes. How is loan situation in our country? Loan portfolio situation in our country.
So, how is the loan portfolio situation in our country? And I assume things like how are loans performing, and that tends to refer more to banks, the people who are lending. Okay, thanks. Next person on this side.
What interested me is if Cytonn would be offering loans and how would I tap into this loan? That was the first one. The second one is in that loan market, if I'd want to make investment, how would I make the investment and what returns would I be getting out of it? Thank you. But the first one would be my first point of interest.
Okay, I would capture how to invest in loan.
For me, I'd like to know the strategies that Cytonn deploys to cover itself and the investors in a loan market situation.
Pretty good point. What are the strategies to cover yourself, provide safety for your investors' money in the loan market? We can take 4 more expectations. There's a lady with the hand up there.
I'd like to know how young people can also learn about investments, because I'm sure most young people are used to spending a lot, so we can learn, let's say, a lot from investments.
Okay.
And how Cytonn, does it have anything for the youth?
I've seen friends of mine who have gone down because they have taken loans. So when I saw this, I wondered if Cytonn is going to train on the discipline that maybe my friends can use, or myself, because out of their experience, I am not interested in loans. So if I can be able to open up and be able to go ahead and take some loans.
Very good point. Discipline in taking and using loans, and I hope it will become clearer as we go into it. When you take a loan, you are a borrower. Now, the purpose of this particular session is how to become a lender in the loan market and make an investment, not how to borrow, but it's going to become clearer. So we've gotten 10 expectations. Now, at the end, we'll come back and see if we have met these expectations. I think if we score at least 70%, we'll have succeeded. If we don't score 70%, we'll see what do we do next. Now, in terms of the presentation, I hope everybody can at least see a screen. Is there anybody who cannot see the screen? Because that's what we are going to work with. Okay, at least everybody can see a screen. This one, a TV screen. Okay. She's asking that we move this so that they can see. All right, so at least everybody can see a screen. You're good? Okay. Now, the title is a little bit misleading. It's not Introduction to Investment. It is Understanding and Investing in Loan Markets. But I think the reason why we have this slide is that we have to put loan markets in context. Now, who can tell me what is a loan market? Because that's what we're here to do, understanding loan markets. What's a loan market? Okay, who can try? Okay, he's not spoken, so I'll give it to Kumar.
Loan market is basically a place.
Stand so that we see.
Yeah, my name is Kumar. So basically, loan market is a place where somebody who is looking for money and somebody wants to give the money. I believe that is a loan market. And secondary, maybe where loans are traded, where in a structured market. I think so. Yeah.
Okay. Any other person with a variation?
Yeah, I just want to add that everybody knows about Shaidoko. So if you know Shaidoko, you know what is money market.
Okay, if you know about Shylocks, you know what's a loan market. Now let's start with this slide and put loan markets in context. Now, typically when we invest, investments can broadly be divided into two main categories. There's a traditional investments. That's what everybody does, or what you call plain vanilla investments. And examples are like equities. How many people have ever bought shares of any company, whether it's Equity Bank, Safaricom, Nation? I'm just trying to see by show of hands. So you can look at around the room, you can see majority have bought shares. How many have ever bought a fixed income? And broadly defined, if you've ever bought a fixed deposit, a bond, T-bills, anything where your money is going to be paid back by a certain percent return that you know upfront, that's a fixed income. How many have ever bought a fixed income instrument? Again, if you look, it's majority of people in the room. Now, that traditional set of investment is also referred to as public or regulated because almost everybody can access it. It's very easy to access. If you wanted to access, let's say, a fixed deposit, you just go to your bank, you say, I have X amount of shillings, I want to fix it for this period of time. If you wanted to buy equities, you just call your broker. So that's why they're called traditional. Another one is public. They also tend to be regulated. The next set is alternative investment. So as an alternative to traditional investments, you have another asset class that's called alternative investment. They're also called private markets investments. And the examples are private equity and real estate. Now, how many have ever invested in private equity? No one at all? Okay. How many have invested in real estate? I would say it's roughly 20% of the room. Now, you begin to see why the top half is called traditional, what everyone does, and then the bottom half is called an alternative or a private investment because it is really hard to access. I'm actually surprised there's nobody here who has invested in private equity, though I suspect that we've done it, but we just don't know, because private equity is essentially putting money in a company that is still private. It can be as early as venture investing or angel investing when somebody has an idea. So essentially your friend comes and says, I have this idea, it can be as simple as I've formed a company, I'll import cars from Dubai and then sell them, we'll make a profit and we'll share. Private equity is incredibly hard to analyze, incredibly hard to make money. Unless you have the private equity skill set, you are unlikely to make money. And I would even say for those who made money, because not everyone will lose, just random chances or random probability, some people will make money anyway, even if they were not sure what they were investing in. Now, the place we are focused in today is somewhere between traditional investments and alternative investments, what we would call the loan market. And let me just take a step back and explain the loan market in very simple terms. If you have money and you place it in a bank, and I think almost everyone here has put some money in a bank? If you have money in the bank, please put your hand up. It's like 80%, right? Now, when you give that money to the bank, what do they do with it? Actually, let me start with, what interest rate have you gotten? Anyone? Just put up your hand and I'll give you the mic, because this is going to be a discussion. I see a hand behind there. Wayne, you should keep walking because the whole setup is a discussion. What rate have you gotten in your bank deposit or in your bank placement, whether fixed deposit, current account, savings?
10% per annum.
So he's gotten 10% per annum. Anyone else?
5%.
Okay, there's 5%.
3 and 10%.
So between 3 and 10%. So we've heard of 3, we've heard of 5, we've heard of 10. Yeah?
0% on current account, they don't give anything.
I think it's regulated by the central bank, minimum interest rate if you're depositing money to the bank.
Sorry, I didn't get your name.
Asking. My name is Merkabu. I'm just asking you.
Yeah.
In most cases, the central bank are regulating the minimum interest rate, actually. I don't know if in Kenya, but other countries who are putting in money as a deposit. So there is a minimum interest rate that you are going to pay on both sides.
So what he's saying is that he thought it's regulated. The minimum used to be regulated, it's no longer regulated. But even if it was regulated, it was for interest earning accounts. So of course what banks did were to move accounts to be transaction accounts. So if you think about the numbers we've had 0, 3 to 10, 5, 10, and there's a guy there with his hand up. That's the last person that will give me a number. 2%. I didn't hear. 2%. Now, you get the point. The banks will collect money. They'll give you anywhere from 0 to 10%. If you look at that as an average, we are talking about 5%. And banks are important institutions. They are there as intermediaries to be able to complete transactions, particularly payments kind of transactions, to keep your money safe. So you have to be very clear. If you are transacting, certainly you should go to the bank. Now, if you want a return, it would not make sense to go to the bank, because if you were to now take the money that the bank has received, we've used 5% as an average. Let's say each person went and put in 100,000, just for example. So if 10 people went in and put 100,000, we are going to have 1 million shillings. Now, if then 100 people went and put in 100,000, we'll have what? 100 million, right? Now we have 100 million. So think about what has happened. All these guys have gone in and put 100,000. Each one of them has gotten 5% back. The bank has collected 100 million. Now I go to the bank as a developer, and now I want to borrow 100 million. Now I will be charged a rate. I talked about what rate have you gotten in your deposit. Now for those who have borrowed, and there's a question somebody asked about the all-in cost, not just the cost you are told that yes, you're paying 13% or 14%, the total cost of the rate you are paying plus all the charges, loan charges, administration charges. Who has a view as to what is the total cost of borrowing that money from the bank? So I'm not talking about the 100 million. I'll even make it easier. Let's forget about 100 million. Let's just say 10 people went and placed 100,000 each. They got back 5%. Now the bank has 1 million, and it needs to now lend that 1 million. What do you pay if you go borrowing that very same 1 million? I'm sure people must have at least borrowed. The class won't go on without your participation. I'm just facilitating. You pretty much have all the knowledge. I'll just bring it together.
I'll give about a mortgage, which should be around 13 to 18%.
Okay, so around 13 to 18%. Anyone else who has experienced borrowing? There's a hand up here, Wayne.
The total cost of borrowing would be the CBR rate plus 4, which at the moment is 13%, plus now the other costs like the negotiation fee, which roughly is 2.5, that comes to 15.5. Then you have other costs like insurance for the loan, maybe 0.5%, that comes to 16. It's actually, total cost would be around 18 to 20%, but what they declare is the 13%.
So she's actually done a good job of breaking it out for you from the, what I would call the face value rate, plus all the charges that the bank will add. And they generally have to add it because there's administration fee, there's a cost of running the place. So when you are done, as she's saying, you'll be anywhere between 16, 18, and it can be as high as 20%. If you actually wanted to see what is the actual cost of borrowing, there's a website out there called costofcredit.co.ke. You'll just go put your bank's name, the type of borrowing you are going to do, and the rate. They have to report that rate these days, according to the new regulations. The rate is actually out there. Now, if you think about what we've talked about, and I'll try to put it on the board, we have 10 people. Each has put 100K. So we have 1 million shillings that has gone to the bank. Now, the bank then turns around and takes these 1 million shillings and lends it out, and they've gotten 5% for their money. The bank then turns around and lends this money, I would say at anywhere between 16 to 18% based on the examples you've given. But if you wanted to know the actual cost, as I said, it's online, it's not debatable. I think actually the average cost of borrowing, if you take all the banks, so there's a function there where you can actually say, give me the average for all the banks. It comes to around 18.5. So the bank then lends this money at 16 to 18%. Now, for our purposes, given that majority of what we do is real estate, the borrower in my example is going to be a real estate company, but it could be anyone. And it could be the people that the lady was talking about, the guys who borrowed and were not able to pay. So as a real estate developer, I'll go borrow the same money and I'll pay 16 to 18%. Then I'll go and use this money to develop things like Alma, things like Amara, and pretty much all the 10 developments that we are doing. So if you think about what has happened, these individuals have given 1 million shillings to the bank. They've earned 5%. The bank turns around, lends it at 16 to 18%. Let's say at 17%, that's the middle number. So if you look at the value the bank has kept, it's around 12%. Now, if you actually go out there and read material about the banking sector spreads across the world, interestingly, you will find that Kenya has one of the widest spreads across the world, and it's actually 12%. You can just go type banking spreads around the world and read whatever you'll get from Google. That's how then banks end up making what I would call a very attractive rate of return. Now, what we asked ourselves, what if we went directly to this depositor and told them, why can't you give me this same money and I'll pay you the 17%? And that's what you'll see as we go down in the presentation. But the point I wanted to make at this point is, if you take this market, because this is a market, it's individuals taking money, putting into a bank, and it's not just a bank, it could be many other companies like an insurance company, an investment bank, but essentially it is an intermediary that takes money and then gives it to those who are going to deploy. This market, generally speaking, is called the money markets. Now, once the money market intermediaries, and principally their banks, get that money, they then lend it out to people who are going to deploy that money, because the bank does not deploy it into any commercial activity. This market where borrowers go to get money, this is what is called the loan market. So the the discussion today is on this loan market and not this market, which is usually called the money market. One of the confusion people make, they go take the 100K, they get into the money markets. And remember, I've just used bank as one of the intermediary. The government is also taking money from money markets. So you take your 100K, you go to the money market, you get a rate. In this case, I've gotten the number from you, it's 5%. Then you also come to the loan market. These are people who are borrowing to go deploy in commercial activities, such as Cytonn to deploy in real estate. And we borrow through an entity called High Yield Solution or Cytonn Project Notes. Then we give you a rate from the loan market. Then you ask yourself, and I think somebody asked, how are you getting these high returns? Because you are confusing the money markets with the loan market. So it's always important, whenever you are going to invest, or whenever you're giving money and getting a return, you have to first ask yourself, which market am I participating in? Because depending on the market, you will want to get the return that reflects the risks in that market. Because remember, here you are getting 5%, here you are getting 17. There's really no difference between these 5 and 17. They are exactly the same return, except that you've taken on more risk. If you are to take your 17% and adjust it for the risk you are taking, you are at the same point as the person who's taking 5%. But of course, you have to take more risk to get a higher return. If the person who's getting 5% goes to the bank and wants their money back, even if the bank does not have the money, they can call central bank for overnight lending. So it is likely you are going to get your money immediately. If you've invested 100K in a bank, even if it goes down, I think you are covered up to 100K. It might take a while to get your money, but at least you'll get your 100K. So the risks you're taking here are much lower, but it is also reflected in the return. The moment you come into the loan markets, you then have to educate yourself. Like, you will never have to go and meet a bank on a Saturday morning to understand how they generate 5%. It is, any bank can give you that. The moment you want to participate in loan markets, now you have to do the work. You have to ask, how are you supporting this 17%? How come your rates are high? So you are taking on more risk, you have to do more work, you have to be here on a Saturday morning, and that is why then you will get a better return than than these guys who are making 5%. You'll get 17%, and that's how the world works. Those who are willing to do more work, those who are willing to do more research, are going to end up doing a lot better than those who are going to take whatever the market gives. So this is the market that we are going to be focusing on today.
I have a question.
Wayne, there's a question here. And by the way, if you have a question, ask as we go.
Since we're taking a higher risk, who's regulating the loan market?
Good question. Who is regulating the loan market? Now, if I go back to my slides here, traditional investments tend to be fully regulated. Alternative investments tend to be fully unregulated. Loan markets, I would say, is somewhere in between. A good chunk of it won't be regulated when you're putting money into real estate. But then how you enter the loan market, in some cases are regulated, some cases are not regulated, because it's a private discussion between the person who is borrowing and the person who is lending. If you take in our case, we started our loan market engagement through a product called HYS, which was purely private, but then we decided, because it's people's money, we are not going to put regulation according to law, we're going to put regulation according to what you would call customs. This is how private markets arrange themselves. If I could just jump to ahead, since you've asked the question. This is a slide I was not planning to go through because it's a little complicated, but because you've asked, given that there is no government, government law to govern loan markets, a good investment manager or a good borrower should put into place regulation, what I would call self-regulation, to be able to protect the interest of the investor. So if you look at this, at top left of the screen is an investment advisor, somebody you bring in and say, why don't you look at what we are doing so that investors get comfortable with the investment they've given us. Then you have an advisory board or an investment board. In the case of HYS, the board is actually elected by the members themselves at an annual general meeting. And then you have the advisory board looking over the special purpose vehicle that actually borrows the money from you. So in our case, that is now the High Yield Solutions Fund or the CPN Fund. And then you have service providers. You have a custodian who keeps the money. Legal advisor, in our case, is Oraro and Company. Custodian is Stanchart. You have auditor, which for us is PKF. You have the Secretariat and Finance Administration, which is an internal function. So if you're going to invest in the loan market, I would tweak your question a little bit and ask the borrowing entity, show me your governance structure, so that you ask your, especially the custodian, the auditor, legal advisor, those are pretty important, and the board, because the government won't do this for you. But I would even go further and say, even if a company is regulated, still try to understand the governance structure, because we've seen it happen. Those who invested in ARM commercial paper, ARM was regulated as a listed company. Those who invested in Chase Bank bond, Chase Bank deposits, Imperial Bank. So regulation will not really protect you, but since you asked, this is how you regulate a private market entity. Another question here?
So on the same, let's say all this digital loan, every day I think we receive SMSs, we take Tara loan.
Can I ask you stand up, because we're actually recording the session. So
yeah. I don't want to be recorded. So the digital markets, loan market, every day I think we are all receiving SMSs, take the Tara loan, M-Shwari, what have it. They fall in the same bracket that they are not regulated, it's up to them. And I wonder whether they have the custodian, the legal advisor, really what goes behind these digital loan markets.
Good question there. What's happening in digital lending and digital borrowing? Now, I have to be candid, it's not a market I'm very familiar with, but I know it's not yet regulated, because the way regulation works, regulation always catches up with innovation. And what happened is the government then regulated what you call ordinary banks, the traditional market, and said you cannot lend to an individual beyond X. And even if you lend, then you'll add all these fees, the maximum they'll get is 18. Now, there are certain individuals, based on the risk characteristics, you want to lend to them, but the minimum you are going to charge them is 20%. So what happened, people then moved from traditional lending to digital lending, which is not yet regulated. Now the government is catching up and coming up with regulations for digital lending, but it's totally unregulated. I'm not even sure about their governance structure, but within the audience, there's going to be somebody who knows about digital lending and how they work. Anybody can help me answer that question? Okay, Kumar.
I believe digital...
You're behind a pillar. Move this way so that
I'll just say a few things what I know about digital lending. Here, they are taking money to invest in products what they have done through research, right? So whatever. On the other side, those people who are lending on the platforms what you're talking about, they don't want to know what you're doing. Their structure is very simple. They need to make 30 to 60%, and they know that 10 to 20% will default. So our brother here mentioned about Shylock loans. So this is a professional Shylock loans, which we need to stay away out of it. And because of interest cap, a lot of people are not taking loans. So what do? You have some urgent needs. You don't have a choice. You go there and you borrow the money because you're getting it. But when you're supposed to pay it, you don't have the means, you already know. And that's when the whole circle starts. So I believe that's what I know about it. There's no regulation, we know that. There's a lot of interest and hype going on in the newspapers where they're saying that yes, they want to regulate it. In fact, if you don't know, Facebook, they've got a company called Branch, They have invested more than 600 million shillings into it in Kenya, which they are lending on a daily basis. So it depends how we are consuming it.
Okay, I hope that helps with digital lending and regulation. The point I want you to take from this page is that loan markets, especially the one that is most relevant to us as Cytonn, falls somewhere in between. We started as HYS and regulated. Now we are moving into HYF. I think within the next 1 or 2 weeks, we should actually launch HYF, which is now regulated by CMA. So the borrowing side, essentially what we've done is to, instead of the bank, we've put in HYF. The borrowing side will now be regulated, kind of a traditional product. But then when we get that money, we shall deploy it into unregulated sector, which is real estate. So that's why we place loan market instruments into the, and somewhere in the middle between regulated and unregulated. Now, I'll go through the next slides quickly because we talked about types of markets and types of investments. If you go to the previous slide, we were talking about traditional and alternative. Now, under traditional, one market is the money market, which is the market I just talked about on the board. Things like T-bills, deposits, repurchase agreements, and money market funds. These are places where if you put your money, and the key thing to remember is that if you're in the money market funds, the person collecting money from you is not going to personally or as an institution deploy it into any economic activity. They are going to pass it on to someone else. They are not going to generate returns by themselves. So the biggest player in money market in the private sector is banks. When banks get money, they will go look for somebody else who needs that money. So whenever you get a rate, as I keep saying, ask yourself, in what market am I playing? So most people are always playing in the money markets. Then there is debt markets. These are treasury bonds, corporate bonds. There's even commercial paper and loan notes. Now, it tends to be when you're in this market, and the government is in all markets, so I would not focus on treasury bonds so much. Corporate bonds and loan notes, these tend to be people who take your money and they are going to do a commercial activity and they've promised you a return. So very different from money markets where they are going to take your money and go take it somewhere else. So within the market where people take your money and go deploy it into a commercial activity, they'll either take it as a debt instrument or they take it as an equity instrument. Now, the difference between debt and equity is simply equity, you are taking all the risks. You can get zero, you can make multiples of your money. In debt, you are taking a little bit of secured risk. Essentially, they have to pay you first before then they pay equity holders. So always ask yourself when you are going to invest, am I investing in a money market? Am I investing in a debt market? Or am I investing in an equity market? The common mistake we make is we get a return in one market and go compare it with a return in another market, yet the risks you are taking are totally different. Now, I keep talking about risk and return. Generally speaking, you can see the returns across pretty much all these asset classes. Starting with structured products, that's where things like loan instruments fall, commercial paper lending, medium-term corporate bond, 5-year government bond, average money market fund, 91-day T-bill, average bank deposits. So you'll find somebody who is looking at an average bank deposit rate at 6.3, then they go back to structured product, or they go back to the bond, somebody who is dealing in the bond market, and ask, how come your returns are not comparable? Because we're in totally different markets, taking totally different risks. So that's an overview to just give you an idea of where loan markets sit in the context of other markets. We just couldn't come and say, here is what a loan market is, without giving you context of how it fits relative to other markets. This again is just a description of loan markets. I think we've talked about it. Remember, when you're in the loan market, you are the lender. When you come and invest in a product like high yield solutions or high yield fund or Cytonn project notes, you are actually lending to us. You are taking the risk that we will take this money, deploy into real estate, sell, and be able to refund you back, as opposed to when you are putting money in the bank, where you are just giving money to an intermediary. Now, these are the key players in the loan market. It starts with the investor, who is yourself. You give the money typically to an arranger. If again, I were to use HYS as an example, we are actually doing the arrangement ourselves in terms of fill in this form, send the money here. That's the job of an arranger or an advisor or an investment bank. Once the arranger gets the money, you send it to now the issuer, who is actually what I would call the person deploying the money. In my example, it is a company like the ALMA or an entity like the ALMA. That's the person who is then, no, actually the ALMA is the person who's using the money. The issuer is the person who's giving you the instrument itself. So the issuer in this case is HYS. And the arranger in our example is Cytonn Investment. Cytonn is doing all the arrangement of this collection of money. And then the issuer is HYS. Then the loan deployment is the ALMA. So the one place, and the reason why we put that last circle in dark green, if you are doing your due diligence, that's really where you should focus on, because that is the place that is going to support the return. So these are the four players that you typically see in a loan market. The investor is yourself, the arranger, and I keep using Cytonn as an example because that's what's relevant to us. The arranger is Cytonn Investment, the issuer is HYS, and the loan deployment is any of our projects, such as the ALMA by Cytonn. I already went through that slide. That's the typical governance structure. Now, benefits of investing in a loan market. Typically, you would say your principal should be protected, particularly if you are investing in things like real estate-backed instruments, such as HYS. The returns are better. I already showed you the returns. Reduced volatility. If you're investing in equity markets, there's volatility. Prices go up and down every day. That's not the case within loan markets. It's kind of an inflation hedge, especially when you invest in things like real estate, because as the price of things go up, then of course we'll be able to reprice the rental income that we charge. There's diversification. You don't put all your money in one asset class, such as equity. Part of the reason why people should invest in loan markets is to diversify. And compared to what you would have to put out to get access to, let's say, real estate, instead of going to buy a unit of the ALMA for anything from 6 to 13 million, you can get exposure into real estate by putting 1 million shillings into HYS. So relatively low capital needed compared to how much capital you would need if you were to go directly into the underlying asset. Now, there's nothing without risks. So there's always risks. There's default risk if we are not able to pay back. There's liquidity risk. That's usually, when people ask me about risks at Cytonn, that's usually the biggest risk, because we get the money, we invest in real estate. If all of you guys came back for your money at any particular point, there's no way we will be able to pay you. That does not mean the money is lost. It just means the money is in steel, concrete, brick and mortar. We have to take time to finish, sell, get the cash back, and pay you back. The best way to minimize the liquidity risk is to run a pre-sales model. The reason why we advertise a lot is so that people know our brand, they're familiar with our brand. When we are selling you real estate, we move quickly to the conversation about real estate, not who is this brand called Cytonn. We like to sell a lot of our units off plan, so that as people pay us off plan, we are able to support the interest that we've promised people on the investment side. And of course, there's a question here.
So sorry for being stuck on the risk aspect, really. So I just want to know, what's your, at what point you self-regulate so that you don't get in over yourselves? Because I know we've seen people who are really high up there, one day they come down. I'm sure they also have the governing body and the governing structure. So at what point do we say we shouldn't move too much or we shouldn't move too fast and manage the risk for us?
Okay, how do you self-regulate? Is it at Cytonn or generally as enterprises? Are you asking about just Cytonn or?
Cytonn, I'm asking about Cytonn and the projects that they're getting into.
Now, in terms of self-regulation for Cytonn, and I would say indeed any other entity, it always starts with the governing body. When Arita presented here, he talked about the what you call the board of the group, which is made up of several independent individuals who are not in it for their own personal gain. They just want to make sure that the firm runs well. So we have an investment committee, we have an audit and risk committee, there are about 3 committees, HR committee that sit and look at how the firm is performing on an ongoing basis. We have AGMs where you will come and ask the question. We also have the management committee. So there are various committees that we have to have in place to look at the affairs of the firm and say, maybe we are veering, we are moving too fast or we are moving too slowly. If you look at some of the cases where people have lost money, it is principally a governance issue. There were no committees in place. So essentially the founders, I don't want to mention those brands, but if you look at some of the real estate brands that have had issues recently, if you were to ask one question, where is your audit and risk committee? There was none. So there was nobody to say, now I think we are taking on more risk. For example, for Cytonn, the investment committee has said, you already have so much real estate. Until you complete these projects that you have today, we don't want to add any new projects. So that's a governing body taking a step and saying, let us now draw the line here. That's the best way to self-regulate. But of course, there's also what you call incentives and ethics. So we try very much at the highest level, everybody to be fully invested in the firm. You don't have people running matatus, doing side businesses. Talking for myself, everything I do commercially is within the firm. Then you also have to look at the individuals, who's on the board, who are the founders, what's their background. So you really have to do the work. Look at the governance structures, look at the individuals, look at the backgrounds. Now, we've talked about loan markets generally, the returns, the risks. So we want to now ground it back to Kenya and give you an example of opportunities in the loan market. So you can have commercial paper, and one of the active commercial papers today is Cytonn General. I think you have to either go to them or they have a few brokers that they work with. So you have to know that Cytonn General actually does commercial paper. There's one that we've not put there, which was a very active commercial paper brand, but unfortunately ran into headwinds, which was Nakumatt. Nakumatt was the most active commercial paper brand. But again, if you had asked yourself, where is the audit, risk, and compliance committee of Nakumatt, you probably would have saved yourself that risk if you were an investor. There are some loan notes that are called equity linked. That means they'll promise you a return. Let's say it's 12.5%. But then they will also say, I'm going to invest this money into something. In this case, for example, Alma. But depending on how the Alma performs, I might add you a little bit of a return. That's an equity-linked note. Then there's certain loan notes that are called real estate-backed medium-term notes. That's the MTN. So somebody like HF, when they issue a bond or when they issue an MTN, it's actually a real estate-backed MTN because the underlying commercial activity or the underlying asset that supports that return is real estate. Then we have structured high-yield solutions where we've given our own example, which is Cytonn HYS. Then we have project notes, which we've given our own example, which is Cytonn real estate project notes. So these are the examples of loan market instruments that you can get in this country. This is not to say this is fully comprehensive. This is just to give you a flavor of where can you participate in loan markets. Challenges in loan markets development in the country. One, they tend to be very complex. You really need to understand what you are investing in because it is not commonly known. They are complex because it is under the alternative or private markets category. Things that are within the traditional, the ones that I talked about, are well understood. Things that are within the alternative or private markets are not well understood, such as loan markets. Yet they tend to give a better return than traditional markets, which are well understood. There has to be continuous education of investors. Most investors do not understand loan markets. I always say there's a reason why we are called developing world or third world or emerging markets. That category of alternative investments is not well understood within emerging markets. So we have to do a continuous job educating potential investors, and that's what we are doing here this morning. And it's good that the room is full with people who want to understand what is a loan market. And remember, even for those who don't invest in Cytonn loan market instruments, and the purpose is not to get you to invest in Cytonn loan market instruments. The purpose is to get people to understand what are loan markets and what's the difference between loan markets and money markets, because if you understand it and then you go invest in another one, whether it is, because Cytonn I'm sure also has its own loan markets instrument, car in general, when more people understand this market and invest, it helps everyone, because now you'll have a category of investors who say we are loan market investors and we are going to lend to companies or instruments that we understand. When that happens, it makes it easier for all participants in loan markets to be able to sell their products. The third challenge is this mentality that every financial instrument has to be regulated. It's good to have regulation, and you've had the question, who regulates it? Loan markets, private markets, alternative investments, by definition are not, or rather by practice, are not regulated. Now you can position it where part of it is regulated, like HYF, and part of it is not regulated, like where HYF invests in real estate. But typically speaking, if you look at instruments in loan markets, they tend not to be regulated. The fourth challenge within this market is what tends to come up. We've showed you the difference between investing in loan markets versus investing in money markets. All we've done is to change this from a bank. If I could just draw it here. So all we've done is change this from a bank into HYS, which is essentially now a private bank. And instead of giving the 17% to the bank, HYS actually just gives it directly to these investors. So instead of 5%, we've changed this to 17%. And once HYS collects the money, it actually passes it on to real estate. It adds another 2%. So once you now start giving the same 17% you'd have given to the bank, you are now giving it to investors. You start getting comments like, the returns are too high, or it's a Ponzi scheme. Why are you not regulated? So these are the kinds of things that investors or players within loan markets have to deal with on a day-to-day basis. But again, there are not many people playing in loan markets, either as investors or as issuers or as companies. So of course the return there is much better. One of the questions we tend to get, how come you've been able to grow so fast? It's because there are not many people who have figured out that you can actually go and give the investor the same rate that you would have given to the bank, and you're going to get the money faster. If I need 1 million, I just need 10 investors giving me 100,000, I get the 1 million. You can do it within a couple of hours. If I needed the same 1 million from a bank, it's going to take me months. So of course I'm going to go faster and move faster than somebody who's relying purely on bank funding. If you look at some of the brands that have run into problems in real estate, it's part of it is because banks stopped lending to real estate when it got challenging within real estate. Now, if all you are relying on is bank funding, of course you then get grounded the moment then those particular banks then stop lending to real estate. So being able to figure out how to engage investors who want returns in loan markets is really important, especially for real estate at a time when banks are shying away from lending. I think that brings us to the end of the what I would call the theory on loan markets. We thought we give you one example that is grounded, and I go back to this diagram. You've invested money. You've given it to us through HYS, and then we are passing it on to the ALMA. Now, when you give us money, remember, not everyone gives us money at 18%. Those who are investing 1 month, I think it's 12%. Those who are investing 3 months, it's 15% per annum. Our average cost of borrowing within this HYS is around 16%. So when we add 2%, we're able to pass it on to a project at around 18%. So here's an actual live example, because you have to be able to connect from your money that you're putting into HYS, the return that you are getting, and then where HYS sends the money. If you go to the ALMA today and look at all the 480 units, the total sales revenue between what has already been sold, which is 60% of the entire project, phase 1 is 100% sold. When the entire project is sold, the total revenue is around 5.2 billion Kenya shillings. Now, the development costs, there's land, which is observable. How much did you buy these 5 acres of land? We paid 500 million. What is the total construction cost for the ALMA? Very observable. It's just in the BOQ with the main contractor. That is 2.6 billion. What is the financing cost? Because we are financing the entire cost from, if you were to finance the entire cost from HYS, because of this 4.5 billion financing cost, there's around 650 that we borrowed from SBM Bank. But if you're to finance the entire amount at 18%, that's 737 that we have to pay out as interest. Then of course there are other costs like professional fees, marketing fees, sales commission, legal costs. That's 670 million. The total development cost, if you add the 500 cost of land, the 2.7 billion construction cost to the main contractor, the 737 financing cost, and the other development fee, professional fees, marketing, sales, commissions, legal, that's 669. You get 4.5 billion. That's the total cost of developing the ALMA. If then I take the 5.2 billion and I subtract the 4.5 billion on cost, I'm left with 660 million or 658 million. That's now what we are left with as a firm. So I hope this helps you tie it from how the money is raised, where it's put, at what particular cost, and is there money left for the firm after we've paid interest. So when people say 18% is not possible, it would be good for them to come, sit down, then we walk them through. This is exactly how we generate the 18%. If you wanted to do due diligence on this, then you would just say, okay, let me go look at the project. Is it selling? Is the 5.2 billion real? Are these costs real? Then I can see how the business model works. Now, this is still not without risk. The risk is to pay that 18%. Of course, the entire investment base, the people who have invested with us, the 4.5 billion, they can't come for the money all at once because the money sits in ALMA. So the risk that team of investors faces is always the liquidity risk. They have to serve their term. They cannot come back for the money early because we then need to keep money in the project. The only thing is that we can still service the 18% interest that we've promised them as people pay their pre-sold units. That brings us to the end of understanding loan markets, and based on the example given. If I look at the time, it's 10:54, so we have a few more minutes for questions and a few more minutes for questions. And it doesn't have to be just on loan markets, it can be on any investment topic that you have in mind. Okay, starting from here.
Thank you. Just go back to the final slide because I think it's very clear exactly where, because one of my questions was, if you're giving me at 18%, what will you be left with? Are you already projecting you will get 25%? But now, the assumption is you sell those units at those prices. But they can go down. The market now is not so good. So does that change the dynamics? Will you probably make a less? I have a feeling you would go at a loss, but you assuming you continue selling at that same price throughout the phase of the project.
Very good question. I don't know if anybody's here from our research team. Anybody from RDO? Next time I'll bring them. We have a research team that before we invest, they go out and check the neighborhoods, and actually we don't even tell them we want to invest in Waka or in Karen. They look at the market data and say, based on what I'm seeing, these are the best places to invest. If you look at our projects that are on ground today, you will notice it's either in Karen or it's in Kiambu County, places like Waka. Karen has the highest concentration of high-end private schools anywhere in Kenya. So in both good and bad markets, Karen does well. You are always able to sell your villas. Of the 10 fastest growing towns, mid-sized growing towns in Kenya, and mid-size is 50,000 people and above, 6 out of 10 are in Kiambu County. So you have very compelling demographics. There's always somebody looking for a place to stay. If you look at this project, I think we are raising prices, not even I think we've already communicated. We are raising prices October 1. Other people are cutting their prices. If you do your research well, there's always a place where people are looking for real estate. I think almost 90% of our time, we're either seated or sleeping in some real estate. Even right now, we're in some real estate. So it's a question of choosing which is the right spot. Now, if you go doing things like office blocks in Upper Hill, for example, there's a lot of supply. So of course the price will go down, you'll struggle with selling. So you have to lead to do this model of borrowing from investors directly, deploying in real estate, paying them 18% and keeping the balance, and your number is about right. We won't do a project unless it will give us around 23%. To do this model, you have to lead by market research. If you don't lead by market research, you are going to have problems.
My name is Mark. Thank you for the elaborate presentation. I still have questions about the model because, you know, overall, the real estate market is not doing well generally. And think of, you know, like those houses in Karen, townhouses go for 100 million per unit. I mean, you may struggle to sell them, you know. So if I put my money there, and I'm relying on you selling these houses, or even in Alma, between 6 million and 13 million, not everybody can afford that in Kenya, you know. So they won't go. There are some delays, you know. So what guarantees are there? If I put in my, say, 5 million, and then you say, after 1 year, you should give me 18%. And then you are stuck with this property, it's not moving. Generally, the market is not good. So, I mean, what guarantee is there that at the end of the 12 months, you pay me my 18%? What some companies do is that they'll tell you, oh, I don't want to economy. So, where do go? Run. So those are the concerns that I have. Yes. Secondly, you've listed other players in the loan market, and you know what we hear, and the challenges you faced. I think it was number 4. It was saying that, you know, you got a Ponzi scheme and all that. Yeah, because they're saying we are in the same market with Cytonn. How come they are making this unbelievable interest rate, you know, and we are operating under the same context and market fundamentals? So, I mean, is it a miracle they are performing? We are not. So those are the concerns that we hear.
Good questions, Mark. First, you talk about guarantees. Regardless of what people say. I mean, the only thing that's guaranteed is death and taxes. So you have to then take a step back and ask yourself, what is the probability that these people will back their guarantee? And the probability for a Cytonn guarantee has to go back to the real estate in Alma, or as you mentioned, in Amara. Now, I would not pay too much attention to what people say. What people talk generally is, what I would say, research shows that bad news or negative news or gossip travels a lot faster than real news. The example I usually like to use is equity. From 10 years ago when it started from a building society, how many times did you hear people saying equity is going down, equity is struggling, it's closing? They've just executed their strategy, and today it's the largest bank by market capitalization. It's the most valuable bank in the country. So for us, we don't pay too much attention to what people are saying. I mean, we just execute and deliver, because you don't expect everyone to be positive about your brand, and especially what you're saying that, okay, because a real estate brand is struggling, they're saying what miracles are they performing, but they won't spend time to come and say, okay, let's go to Karen. You're saying we're selling houses for 100 million in Karen. Yes, we are selling them for 100 million, but today if you wanted to buy one, I don't have any. It's all sold. The other mistake we make, we are not, especially Nairobi, you should never really look at your neighbor as your competition. If I look at Karen today, the units that we have, some of the buyers or some of the renters are people in global markets. We have a tenant who is an entrepreneur in the US, 20 hospitals. They are trying to also do something right here in Kenya. So when they look at the unit, this is a billionaire in dollars. So one unit is $1 million for them. So you ask yourself, who is buying this thing at 100 million? And you look at yourself and your neighbor. Nairobi is a global business hub. If you look at Alma, some of our buyers are people who are coming from the UN market, US embassy. There's a reason why that market does well. Limuru Road, Northern Bypass, the places around Gigiri. You are not competing. You are not competing with you and I. You're competing with the UNEP kind of environment. So you have to pick your spots pretty well. The other day, I don't know if you've heard of a company called Abbott Laboratories. It's a leading US diagnostics company. They just came to Kenya and they went and set their Kenya headquarters at Watermark Business Park in Karen. Now, you can see what they're doing. From the airport, they don't want to come into the jam. They'll take Southern Bypass, get to their headquarters. If the headquarters in Karen, where will they live? Somewhere within Karen. And it won't be anywhere within Karen. It's going to be Miotoni area, Windy Ridge area. There are 4 or 5 areas within Karen that multinationals want to stay. Now that person will, and actually in Miotoni today, you're talking about 100. The reality is we have a development Applewood where the price is 142. Now somebody will come and buy the 142. Then you'll say, who is buying at 142? Of course, there's still the corruption money. There are usually 3 kinds. There's corruption money, there's entrepreneurs, and there's foreign investors. You can divide the buyers into those 3 buckets. So don't look at you and I and say, who is buying? A lot of people are buying this real estate. So you do your due diligence, but also be aware about your risk appetite. Not everybody can take risks. If you are the type that wants to sleep very soundly, knowing I would rather get my 5%, but have a good sleep, and I don't want to take the risk of 17%, once you know that's your type of individual, then you don't take risk. I used to have a client who, every time they read something in social media, they would come to me and say, reassure me. And I did it 2 or 3 times. The 4th time I told her, please take your money, because we cannot at any point, whenever you read something, we cannot, if every client were to do what you are doing, we can't run a farm, because now we'll be setting meetings every time there's social media attack. So you have to know your risk appetite and also diversify. We are not saying put everything in loan markets. There's money that belongs to the bank. there's money that belongs to government bonds, there's money that belongs to equity. We are saying within your financial planning, there's around 10 to 15%, 10 to 20% of your money that you should take higher risk with. Allocate that to loan markets. The rest, take it where it belongs.
You've also given us a good assurance on the capital guarantees that your investments are good, yes. What recourse would I have if, as an investor, in case you don't deliver on your promise? And when you look at the other players you talked about who are also within the private equities, they have other mechanisms which are well defined within the regulated markets of how then they would proceed. So here now we are in this unregulated scheme, and in the first instance we looked at what was in the room, and most of the people who have made investments in private equities or in the private arrangement end up losing. So what confidence can you reassure us in this? Thirdly, probably my last is your reports. You told us that we need to do due diligence, and being that the reports are not public, how could an investor get to probably see these reports and to see really that which you are doing backed by your financial statements, or even financial statements for that matter?
Okay. So let me start with the one we've talked about, liquidity risk. Liquidity risk, like any other risk, default risk, economic risk, you have to manage it. So if you think about our HYS, for those who've been in that product for a while, there's a point where we say you cannot withdraw. It used to be you can come and do an early withdrawal. So we amended it and said you have to serve the full term of your investment. But life happens, we still keep a little bit of flexibility. So you can withdraw up to 25% of your investment early, but 75% you cannot withdraw early. Even the 25% that now we allow you to withdraw early, you will lose 50% of the interest earned. Your principal we won't touch, but the interest earned, you will lose 50% of it. But if you take money at 18%, even if you get 9, you're still better than if you had invested it at 5%. So we make it more painful for the investor to actually say, I want the cash. Now, we also try very much to build liquidity. Of the entire 11 billion, you can't take it all, and 11 billion is what we've collected from investors in this HYS fund. You can't take all of it and put into real estate. You have to keep a certain amount of liquidity just in case people come for their money. The liquidity risk that I'm talking about that is very difficult to manage is if, for whatever reason, these 11 billion of investors come and say, look, we all want our money at once. There's no financial institution that at that point is not even a Cytonn issue. Even KC, there's nobody who can withstand a run on liquidity. At that point, we'd have to tell you we can't pay for this particular reason, but it is not a risk that is unique to Cytonn. It's a risk that every financial institution has. However, a bank is best suited to manage liquidity risk because they can get a central bank lending. So that was just to let you know that, look, should all of you want to come for your money, unlike a bank, I won't be able to give you. So allocate that money that you don't need to come running for. Allocate that money that you want to invest and get an attractive high yield return. The money that you might want to run to for an emergency, please keep it in the bank and earn the 5% because it will be there for you when you need it. I had a case where somebody came and said, I really need my money because my daughter has applied and has been admitted to a college in the UK 3 months after investing. So I asked them, but you should have known your daughter was looking for a college in the UK. You cannot come and lock money here for 3 years, then come after 3 months and say, I want to send my daughter to the UK. Then you should have come and put it into the 3-month category. Then we can look at it and say, we know we need to pay this money in 3 months. So those are the ways we educate. Even right now, part of what we are doing is managing liquidity risk. That money that you know you will need in 6 months, you can't come and lock it for 3 years. Come and just put it for 6 months. Then private equity, you mentioned something. the people who lost, majority of people who invest in private equity as individuals, statistics show they will lose their money. But they are not losing because of private equity. They are losing because they are not private equity professionals, and they are now trying to be a professional. They should have gone through a private equity investment manager. So I was not saying private equity is bad. I was just saying it's very complex. You really, really need to either not invest or invest through an investment manager who understands that asset class. I do get a lot of investment proposals. I never even look at them because I don't understand that sector. I don't know the individual. People will tell you how much money you will make, but the focus should be how much money can I lose? And for you to know how much money you can lose, you have to be an expert in that sector. And for me, I'm only an expert in the sectors that Cytonn invests in. There was a question of assurance, which seems to be the same question as guarantee. I keep reminding us that it's only the investment that will guarantee. On the issue of reports, there are reports in two sections. For every project or for every market where we invest, we release a research report. If you wanted to understand Ruaka, just go to our website, cytonn.com, go to the research tab, type Ruaka, you will see the research we have on Ruaka, type Karen, and then you'll be able to, and we actually even show the neighborhoods and the assumptions. Now, the financial reports, we have the group, which remains a private entity. Then we have the regulated funds, things like money market fund. Those reports we must release by regulation. Then we have the HYS. Those reports we also have to release by the, what is it called, the partnership deed of HYS. That's why we have an AGM. Now, if you then wanted at the group, then you just have to tell us, why do you want this report at the group? The company is a private company owned by around 200 individuals. If you're not a shareholder, why do you want it? If there's a good reason, we'll share it. But all the financial information is available. If you've tried to get any information and you didn't get, just let me know. I'll get it for you. And it's I'm easily accessible, ceo@cytonn.com, and we shall respond.
In the month of October, we'll be having another training on asset allocation. So that's a training you should attend, which then we would be able to advise you maybe between 20 and 30. What is your risk? Should you invest more in real estate or less in shares? Something of that sort. So please feel free to be always checking our website to, you know that link you RSVP through. You can always go there again and choose what topic is there, and if you want to attend. We highly welcome you to be attending.
I would like to invest on the houses that you are developing and on rental income. The houses that you have already developed, let's say the ones at Alma, in case I don't want to stay in, I want to rent it out. Does the rent cover the mortgage maybe I may take? Let's say it's about 6 million, and I'm paying a mortgage for 15 years, and the rent I would gain out of it, will it be able to cover the mortgage? That is my question.
Remember, there's a reason, I keep going back to this word emerging markets. Now, our capital appreciation is still very high. If you're going to invest into real estate for rental, you can't just invest for the rental alone. The rental will not be able to cover the mortgage. But the total return being you take your yield, so essentially the rent you'll collect over the year, divide by the amount you paid, you should be somewhere around 5% in this market. Then you know, okay, I'm getting a good rental income. And then after that, you should add what is the capital appreciation, which should come to anywhere between 8, 9, 10%, so that your total return is around 15% in real estate. You should not, unless you're investing for other reasons, you know, there are people who want to hide money, or they just like the real estate, or they like the location. But you see, investments is about return, and returns that are calculated and highly probable. So you should get to around a 15% return. That's when you should invest. But you are unlikely if you just say I'm putting 10% and I'm borrowing 90% from a bank, it will not cover your mortgage, especially given that mortgages are around 12 years.
if you're able to get a mortgage of around 25, then it certainly should. But to answer your question well, we would have to take the unit, sit down and do the calculation. So I'm giving you a general answer, but a specific answer, we sit down and you say, this is the unit I want. How much can I get in mortgage? How much can I get in rent? And then you also talk to the bank and you say, give me a mortgage calculation on this. And then we look at the difference, then decide this difference, will it be covered by capital appreciation? When I'm done, I should be able to now say the amount of money I'm getting was worth actually going through the mortgage. So let's take it offline as a conversation. Mergers and acquisition, what would happen to Cytonn? First, it depends on what the 200 or so investors want. But conceptually, we always say the client comes first, then the brand second, the team third, and then the individual fourth. So if the proposal makes a lot of sense for our clients, then why not? The proposal will need to come, but at this particular point, we've never gotten any particular proposal. And in fact, the way Cytonn came to be was because we did, wherever we were, the founding team, it didn't make sense for our clients and for ourselves. So we said, why don't we just go and do these things in a manner that makes sense for our clients and ourselves? So it's not something that we really do think about, but we are always open to it. After the mergers and acquisitions, what was the next question?
The total investment experience.
Or the total investment experience for the whole team or the leadership team?
Well, yeah, the team.
I'm
the
not,
ones we entrust our money.
I have not calculated it of late. Myself, it's 20 years. I think Elizabeth is 15. Patricia in investment, legal, probably around another 15. But we'll calculate it. If you just give me your email, I'll send you the answer, or give the question to Wayne. Give your contact to Wayne, we'll get you the answer.
I think there's a clarification. I think when you were giving this slide, you did say you didn't get all the money from, let's say, CYS, the depositors, you had to go to the bank. Or is, let's say, ALMA, are you able to build or bridge all the phases without needing a bank loan? And in case you need a bank loan, since we are giving you a return of 18%, the bank will probably give you even better. Probably to give you at 14% because it's regulated. So there is that question, how would you be able to give me 18%, yet you can get better, even more money, probably 14%.
Very good question. Sorry, what's your name?
Jane.
Now, Jen is asking, are you financing from banks? We are financing from SBM Bank, which is now a banking partner for Cytonn, not just for ALMA. They give loans to our staff. We are applying for SBM, State Bank of Mauritius. The former Chase Bank was acquired by SBM Bank. So SBM Bank is our principal banker. Now, if you're doing real estate, you need diversity of funding. Some funding comes in kind. That means somebody brings in a joint venture, they bring land. So you don't have to spend the money to buy the land. Some of it will come from our products, such as HYS, CPN. Some of it comes from money market fund. We allocate 10% of it into our own products. Some of it will come from banks. So the 4.3 or 4.5 billion, 650 million will come from SBM Bank, and their cost of fund is cheaper because they are lending to us at 13. Then they charge us other things. When we do the total cost, it's coming to around 16%. So the good thing about bank funding, it's long term. It is 3 years, it's cheaper, but I can't develop. Now imagine if we were only relying on bank funding, which is 650 million, that's what we've got, and we can't do this development. So you need a diversity of funding. The downside of funding directly from individual investors such as yourself, Jen, individuals are also, I would call it, more volatile than institutions such as SBM. When the CEO of SBM reads something in social media, they are an institution. They'll ask their legal person, look at it, legal will say there's nothing there, that's politics. They won't call me. If an individual sees these things in social media, they'll call their financial advisor, tell me about this. So while borrowing from individuals like you, it's more expensive, the positive side is that we move a lot quicker than the bank. The downside is individuals are more fickle than the bank. So you need both, and then you tap into funding depending on the challenges of the day or the demands of, the project demands of the day. So we need that diversity of funding. If you take a brand like Suraya, one of the reasons they ran into problems, they only fund from banks. They are not funding from individual instruments. So when the bank then says, I'm not lending, then of course you are going to have an issue. Now for us, bank lending is very minimal in our business model. Wayne.
Yes, my name is Ellen. What I would want to know is about the HYS. You're getting into the regulated market. What are the implications apart from the interest rate? And possibly you say the term. What would be the implications in terms of risk? Does that remove the risk completely, or exactly where will be the lenders be?
It won't remove risk completely, but it will reduce the perception of risk. There's a lot of stuff that is more about perception. When people hear that CMA, in reality, the risk doesn't change because it's still investing in the same projects. Now, the real risk is, can I develop? And if I go back to Alma, the land remains the same. The BOQ remains the same. The consultants are the same. The fact that it's regulated by CMA doesn't help me sell the units faster. So the sales risk remains the same. So the underlying risk won't change. And if you really talk about returns, returns come from a commercial activity, which CMA cannot control anyway. The only thing that now changes is people feel much better when there's a CPK, Insurance Regulatory Authority, CMA, around the product. They feel that, okay, I'm not just dealing with that entity or that management team, there's somebody in between. Now, once perception of risk then comes down, that means the number of people who now want to invest will increase. When the number of people who want to invest will increase, the rate has to go down because now the inflow of money is a lot higher. So for us, it's good because the rate will go down. The term, now you will be locked just for 3 months. We can no longer lock you for 1 year, which is a benefit. I'm trying to see what other changes will be there. I really don't see. Actually, to be candid, it's better for us than for the investor because now the cost of money moves from 18% to 14%. For the investor, it's also good because the taxation rate then comes down.
It's a very big benefit.
Yeah. Taxation is a really big benefit for the investor. I think it's good for everyone. It's good for the investor, it's good for us, it's good for CMA because they'll be getting a fund that is 11 billion. It's going to be the second largest fund after CIC's money market fund, which is around 22 billion. So it works for everyone. And then the investor who's really sharp will say, I know that the risk has not changed. I'm still taking the same risk. Returns have come down. So I'm going to go into CPN so that I sustain my high returns. Thanks a lot for taking the time. Now remember, building this brand takes both parties. We do our part in terms of investing your money, delivering the returns. We do our part in terms of training, but I'm always asking clients and prospects to also do their part by understanding the product, by also getting us referrals. Those who have enjoyed this product, like Jane, Mildred, and the others who are around, Kumar, make sure that at least you are always giving as referrals and also defending the brand and explaining. What we are doing, of course, is threatening to market participants, especially the banks, who we have no issues with. They are very important players in the market. But now when you are going to somebody who has money that should be getting 5% in the bank, then you are telling them, give me the money, I will give you 17%, Of course, there's going to be a lot of players and a lot of banks who are out there saying this is not possible. It would be good that you tell them, look, and especially now that we'll send you the presentation, it's possible. Come either for training or let's sit down and I explain it for you. The people who can defend the brand the most are not us, because if I am the CEO of Cytonn, of course I have to defend the brand. The most effective defense comes from people who are already in the product. The other thing is that the best way to sell other than referrals is testimonials. We are always looking for clients who can give a testimonial, and a true testimony in terms of this has been my experience. These are the things that have been good, and these are the things that I have struggled with since I was a client. It helps us to grow and sell the brand. As I mentioned, we need to raise another 60 billion shillings for us to complete all our projects. We won't do it all at once. It will take us 7 to 10 years. To do that, we need you to put in more money, we need you to get us more clients, and we need you to defend the brand. So also do your part. It can't just be investing and enjoying the returns. Please help in terms of growing the brand through testimonials, referrals, and educating people about this business model. Did I see your hand up? Okay, Kumar wants to say something.
I could not.
You're behind the pillar, so
I could not wait to talk, but I'll just take 2 minutes. It started with Hetal. Hetal, she's still there? Hetal introducing me to the company. I put in 25,000 shillings in the Alma. That's how the journey started 4.5 years ago. Right now, I've got Alma, I've got Ridge, I've got CPN, I've got High Solution, I've got the new SEIP product, and I've got a lot of experience. What I'm saying is, the message what is giving here, if I can say in one line, is do your homework, because I've not seen any other company who has done so much of homework. So I think we should have a round of applause for Cytonn, Edwin and the team. For one reason, what I like about it is, I'll tell you what I don't like later on. So first is the research reports which have been coming since last 4 years. I mean, do you know any other company in Kenya which has been supplying us reports even when we are not their customers? So that is one. If you go inside the research reports, it talks so much about the places where they have put in Alma. In fact, I invested Alma even without going to the site. And as of today, I've been to Alma more than 15 times. I've been to Ridge 4 times. I've been with them personally and on email with all their team many times. I'm also a finance guy. I've been in Kenya for 20 years. I've been managing finances for companies where billion shillings, 500 million, those kind of companies where you call me an accountant or a CFO. From there now I'm looking into my own life as to how I want to manage my money. So if anybody wants to know anything more, rather than having it from internal financial advisors from Cytonn, or you want to understand it in a local, in a simple man's language where we don't understand investment, you can always talk to me. So that's what I wanted to add. And I believe when we talk of risk, for a common man, it is not about risk, it is about trust. So the trust is not created by watching things or by starting things like what we have done, but it will come over a period of time, and where we are going to share our stories with each other, right? So in 4 years' time, if I tell you the return what he's talking about, I think people who have bought off plan have got huge returns. I'll tell you just one of mine what I got. I invested 700,000 shillings with a 10% investment plan when I first did it. It was sold to me at 7.7 million. So on a 700,000 shillings, I am right now making 2.4 to 2.8 million shillings, because currently they are selling Alma at 9.5 million shillings. And by the time Alma is going to come out, I think it's going to be at 10 million or 11 million, because for us, where we are living in a house of 4 to 10 million shillings, which place do you have a swimming pool, you have security, you have got biodigester, you have got daycare, you have got so many things. I don't think so any place in Kenya right now, you have a place where all these amenities are there. So the place where we are living and the place where people are investing is changing in a very big way. So that's what I want to say. Thank you.
Thank you very much. I'd like to thank the audience for coming today. And also we have a feedback form circulating. Kindly fill it for us so that we can serve you better. And there are financial advisors. So if you have any extra questions, there's always a financial advisor to assist you. Thank you very much. If you've not had tea, there's a point where you can have tea behind there.